Here's a question you may have wondered about. I know I did when I first started here at Capital. What's the difference between trading and investing? They may seem interchangeable at first glance, but they're actually two very different approaches to managing a portfolio and interacting with the markets. In this video, we're going to break down what those differences are, and we'll look at why some people prefer trading and others prefer investing. Stick around. Both investing and trading involve buying and selling assets in financial markets, with a view of hopefully making a profit. But that's about where the similarities end. What really differentiates the two approaches are the frequency and time frames involved. Investing involves buying assets, be they stocks, bonds, index funds, real estate, what have you, with the intention of holding that asset for a long time, maybe months or years, decades. It's generally passive and relatively low risk, with the general goal of steady but modest returns over a long time. Trading, on the other hand, is a much more active and fast-paced approach to the markets. Traders buy assets with a view to sell them as soon as they've made an acceptable profit, or to cut them loose if they experience a loss, which is a very real possibility. So the defining feature of trading is its frequency, anywhere from a few trades a month up to dozens of trades per day, or even more. Now that we've covered the basics, let's get a bit more granular, starting with finance's favorite four-letter word, risk. Risk appetite, or risk tolerance, is probably the deciding factor for whether somebody chooses to invest or to trade. So, how do trading and investing compare when it comes to risk? Well, investing can be relatively low risk, thanks to the longer time horizons involved. The thinking goes that an investor who holds an asset for the long haul can ride out short-term market fluctuations, be they blips or recessions, and that over a long period of time, well-chosen investments could appreciate in value. That's not to say investing is risk-free. It's definitely not. Markets behave in unpredictable ways. Entire sectors fall on hard times. Wars disrupt supply chains. You get it. This is why many investors diversify their portfolios and might apportion much of their capital to market trackers like index funds and ETFs. Now, what about the risk profile of trading? Here is where the warning lights and capital letters come in. Trading comes with significantly more risk than investing. That's because over the short time frame that traders operate in, many assets can be super volatile. Prices can rise and fall in minutes, maybe faster, and often unpredictably so. That volatility is actually what traders are trying to take advantage of. Traders attempt to buy an asset that they believe will rise in the next, say, hour, day, or week, and then sell when they've achieved their desired profit margin, or cut loose if the price falls to minimize their losses. The frequency of these trades combined with the volatility and unpredictability of the market means that even experienced, dedicated traders can experience frequent losses. In fact, many traders are happy with a win-loss ratio of just over 1-to-1, so many traders would be happy to make a profit on just over half of their trades. It's important to note, not all trades are equally risky. There are lots of different kinds of trading, each with different risk levels. For example, trading on margin, meaning with borrowed money, is much more risky than buying stocks with your own money. Both are risky, but one is much more so. I want to tell you about our channel. Here at Capital.com, we make explainer videos about investing and economics, giving you the insights you may need to understand what's going on in the markets and to make informed trading decisions. We're also a trading platform ourselves, so you can make your trades right on our website or using our app. After this, you may want to check out our film about gold prices. But now, back to the question at hand. What's the difference between trading and investing? So why does anybody choose the riskier route anyway? Simple. They're seeking bigger returns. Higher risk, higher potential reward, right? That's the idea. But, important note, there's always the higher risk of bigger losses. This is where mindset comes in. The thinking behind investing is trying to beat the market is a fool's errand. Most people will lose out in this pursuit, and there's no reason to expect that you'll be an exception. So investors choose instead to chart calmer seas, content with lower potential rewards that might be around market averages. As long as those rewards outstrip inflation and the interest on a savings account, an investor can count the returns as a success, however modest. Traders aren't usually happy with modest returns. They're willing to take higher risks in pursuit of higher rewards, and they try to do so by paying close attention to how the market behaves in the short term, trying to make moves that might reward them with greater profits than potentially gained by sitting on an index fund, for example. The flip side of that, of course, is the higher risk of losing money when it comes to trading. So how do traders and investors make decisions about what to buy, when to buy it, and when to sell? Well, here's another key difference between the two. Many investors will research a company or other asset before deciding to buy, sell, or pass. This is called fundamental analysis, and it can involve a lot of reading into quarterly and annual financial reports, the news, a broad understanding of what's going on in the economy, and a dose of intuition. Traders don't usually bother with this kind of qualitative analysis. Since they operate on such a short time scale, traders often focus instead on charts. They try to forecast where prices will go based on how they've behaved recently. This is called technical analysis, and it involves analyzing candlestick charts, using indicators like moving averages, and searching for patterns that tend to precede certain price movements. Both investing and trading often tend to reward an analytical mind, but applied in different ways. Investing in a qualitative way, that's more about interpretation, and trading in a quantitative way, that's more about numbers and charts. So which is better, trading or investing? Both and neither. Whether somebody chooses one or the other depends largely on their goals and their risk tolerance. Traders aim to profit in the short term by buying low and selling high, or buying high and selling short. This is really hard to do consistently, and it carries a high risk as markets often behave erratically and unpredictably, so a lot of traders lose money in this quest. Investing carries much lower risk in general and is usually more suitable for more people. The goal of investing is just to participate in the market long term and achieve financial stability. Investing can still carry significant risk, especially angel investing, for example, which involves providing seed capital to growing startups, since the risk of business failure tends to be so high. Ultimately, whether you choose to trade or to invest will depend on your goals, your risk tolerance, and your personal preferences. It's crucial to remember that both trading and investing carry a risk of losing money. I can't stress this enough, and there is no such thing as guaranteed returns. It's crucial to do your research before making any decisions with your money. Thank you so much for watching. I hope you found this film interesting and enlightening and useful. If you did, you can find more like it on our channel, Capital.com. If you want to trade the markets, Capital.com provides the tools and insights you need to learn, trade, and invest smarter. Tap into up-to-the-minute market insights and trading signal tools, the Capital.com Academy, and watch more of our films, all for free. And the Capital.com platform provides thousands of instruments on global markets that can be traded as CFDs. Just tap the link in the description or search for Capital.com in the App Store. See you next time.